There is so much noise that's out there. There's way too much noise. Everybody has an opinion on real estate. I mean, everybody. You go anywhere and they'll tell you what's going to happen to housing, including me. And I find it funny because I've read these economic books and I've actually read these markets and I kind of know what's going to go on. I really know what's going to happen. I think I said it in this room. I don't remember when we did it last, but I was talking about how the market's going to evolve and change with higher rates. And it has happened. I don't focus on closed sales because I do not like to talk about what's happened in the past. Rarely do I talk about it unless it's really extravagant and I need to talk about it. So I don't focus on what's happened in the past. I focus on what's coming up right now and what's going on with your buyers and everybody else out there right now. The available number of homes to show your buyers today, more than a couple months ago. And demand, it's a snapshot of the last 30 days of escrow activity. I'm looking at that number over and over again. And the only thing that's killing me, but it's going away, are all those people that they don't place their home on the market, but they place it in and put 0 days on market and place it right into a pending or a closed status. It skips escrow altogether. You're just putting it in there as because you want to fluff your numbers. I understand it, but I sure wish it was in the MLS because that is the best way to represent sellers. But so my demand will be off just a tiny bit, but that's going away really fast. Expected market time, that is, you place your home on the market today, when are we opening up escrow? And that's what everybody should know. And it's not days on market, it catches real time exactly what's going on because it's the nuances of all of a sudden more escrows or less escrows. And I can see what's going on in the marketplace before it's happening. I can talk about what's going to happen with closed sales. And what I'm talking about now is going to be in the papers 2 months from now. So that's really why I do what I do, because I want you to be equipped with exactly what's going on today. And it is, they're used for the marketing, for your buyer and listing consultations and price reductions for sure. This is the year of the price reductions. What are the current number of price reductions for all of Orange County right now of the inventory? Does anybody know? 19% of the entire. And it's higher in other markets. I'm going to get into that in a second. And it's get buyers off the fence and into escrow. And that's really what they're saying dumb things like, I don't want to buy at the top. I'm going to wait for values to go down, a correction, all that stuff. I want them to sit down with me so that I can tell them exactly what's going on, because they're making a horrible decision for their family if that's what they're waiting for. So it's also about closing more transactions by setting expectations. And I have reports that dot all over Southern California. LA, Orange County, and San Diego got theirs this week. Next week will be San Bernardino, Riverside. Coming soon is the Bay Area. I have a year's worth of data actually at the end of this week. We're going to probably launch in July. I know exactly what's happening in the Bay Area. I actually know what's going on in Phoenix also, and Vegas as well. So this is what the reports have looked like so far. Unprecedented start. We had the most ridiculous start this year. 2013 was ridiculous. Last year was even more ridiculous. And this year was the biggest, most ridiculous market I had ever seen. I thought it was out of control before. It is really out of control, or was more recently. You guys are still telling me these anecdotal stories of these buyers that are willing to pay $200,000, $300,000 above the list price. That is the dumbest thing they can do. I actually got in a little bit of a healthy debate with a lender telling me why. No, but I just tell them that they need to be in it for a long time. They can go ahead and pay $200,000, $300,000 above the list price. That is not the answer. I'm telling you right now, these are the people that are going to get burned in a few months from now when people are really scrutinizing the comps. So please do not overpay. There's plenty, 19% have been on the market and have reduced their price, which means those are the vulnerable ones. They don't have that just listed on there. And they can't get that back. They can just get price reduced. So rising rates versus no inventory, that's been going on. And then going, gone. This is an auction-like atmosphere. I've talked about that. And it's still kind of like an auction-like atmosphere if you price it right out of the gate. Will it slow in 2022? So I talked about this in February, what it's going to take to slow, and it definitely happened. And out of control. Like I said, last year was unhealthy. This year is out of control because of everything that I heard. and especially in Orange County. Do you know that in the month of April that it was over 7%? It was 107% of the asking price. That means that on average, all homes in Orange County sold 7% above their asking price. How does that sound? I had to look at all the numbers to make sure that there wasn't something wacky in the numbers, and it's true. So you guys are dealing with some really incredible appreciation here in Orange County. Housing cracks. So I talked about when I started seeing the cracks, unexpected slump in demand, so demand started to drop. The sky not falling, that's the most recent one. Because now I have to recalibrate. I've said it's cracks and all that stuff, but now I have to recalibrate and let everybody know the sky's not falling. This does not mean that we're going to have a buyer's market. That's not what I'm talking about. But anyway, where are rates headed? So this is the 10-year Treasury. The reason I follow the 10-year Treasury is because this closely mirrors what happens with the appetite of the investor that buys 10-year Treasuries, the same one that's looking at 30-year mortgages. So because of that, I look at 10-year Treasuries to figure out what's going on with interest rates on a daily basis. I look at other things, but this thing tells me really fast exactly what's going on. And CNBC does a good job of showing me up to the second what's really going on. So at the beginning of the year, we had a spike in rates. That's that green arrow. And then it was level, and then Ukraine war started, and it went down. And then after that, I was telling everybody lock, because this is going to be not good for the overall inflation narrative that's going on. And then we skyrocketed. And we have been hovering around this 3% for a few weeks now. And it's having a hard time breaking up further or coming down, but we'll have to see where it goes. But it looks like it's kind of found somewhat of a ceiling right now. But that doesn't mean interest rates haven't gone really out of whack. These are interest rates. And I take it from Mortgage News Daily. I used to take it from Freddie Mac mortgage market survey that they've been doing for 51 years, but I no longer do it because it's a week. And it's so old by the time I get it that it actually is an irrelevant rate when I quote it. So now I go to this on a daily basis, and this is more relevant to what you're looking at. And also that it's with 1 point and 20% down. Not everybody does 1 point and 20% down. There are more people paying points though right now in order to get their rate down. But can you imagine sellers down the road are going to be paying your buyers points so they can get a better interest rate? It's coming for sure, or buy downs and things like that. It's already happening. Do you hear this? See, I am like Nostradamus. Nostradamus, that what it is? 5.5%. This is where interest rates are right now. You draw a line across. Last time we heard was June of 2009. Do you remember June of 2009? I don't remember June of 2009. I can't remember what I did last week. So I have no idea. And then this is this highest push of rates that we've seen in a super long time. It's actually the largest rise since 1981, but 1981 was so high, it's stupid for people even to talk about that. It's not even going to do that. It's not going to even come close to that. So I have to say it's slightly higher than 1994. 1994 is the last time we got a big bump, and that's kind of what it's doing right now. And this is, thank goodness, this is actually compliments of First American's economic team. They updated it. She was off of it for like 3 weeks. She actually went on vacation. I can't believe it because I needed her chart for a few meetings. And I didn't have an update. This is on a weekly basis. You can see what happened. Actually, 2 weeks straight, mortgage purchase applications went up, which means they kind of found a bottom. But something happened in the last week, and this is the yellow line. It went down 12% week over week. So it really sank. And a matter of fact, it's down 15% year over year. It's actually below 2020 at this point because 2020 bottomed out, but then this is where it started to get good and people were getting mortgage applications. Remember May of 2020 is when things started to turn around. Well, we're below that, and we're below several years back. So you have to understand purchase application volume is down. Why is it down? Because of where rates are at today. And that's because of this. There's a lot of people that are turned off by this. This is national. This is done by Black Knight. If you look at this, this has been going up and up. You can see it. This is actually done on a monthly basis, and this is where it's at. 31.2% is the national payment to income ratio. And so I follow actually every single county. So I know there's different counties. Orange County is in the red. As a matter of fact, all of Southern California is in the red. I did say rosé before because it was like not quite totally bad, but it was getting there. And then now that we have interest rates above 5%, it is definitely a red flag. As far as red flags concerned, I'm looking at incomes, I'm looking at rates, and I'm looking at prices. because prices went up as high as they did, the interest rates were so low it didn't matter. But now that rates have gone up 2%, it does matter. And that is what is going on here. So this is national. The last time we were this high was when we were coming out of the height of the Great Recession. That does not mean that we're going into the Great Recession. Please, don't get me wrong. It just means that it's so unaffordable that now buyers are backing off. Back then, they were doing teaser rate loans and dumb things like that, and dogs were getting properties, and a ton of adjustables were being done, and dead people were getting properties, a lot of fraud. So you understand that was when we set up the Great Recession. But we're not setting that up. Instead, we have these higher rates, and what's happening? Buyers are backing off. That's what's happening. And so you're wondering what in the world's going on with rates? Well, inflation. Inflation has a lot to do with it. Not transitory at all. And you could see this is the CPI, came out last week. This is Consumer Price Index. Headline is 8.3%. It's actually down from the month of March to the month of April. So know that CPI kind of has found a ceiling, but the ceiling is rather high. And this is not where they want to be on a month-to-month basis. Even if that went from 8.5 to 8.3%, that's not good enough. The core is at 6.2. That too went down. It's also not good enough. And so if I draw a line across, the last time we were here was, what, 1981 again. But remember, look at 1981. Inflation went way out of hand. It got above, it's like 15% versus what we are today. So you have to understand, we're not getting to this kind of inflation. It's kind of finding its top, but we are going to be dealing with inflation for the better part of this decade, which means that rates are going to be extremely volatile. It's going to be all over the board, which means you have to tap into your lenders because they are going to know exactly what's going on a daily basis. It's constantly changing. And there are different products that are coming available and things like that. So, oops, did I just do that? I did. So there's the war with Russia and Ukraine. Number one, affected the gas pump, right? I know it affected the gas pump because our family drives a Yukon XL. That's what you got to drive when you got a lot of kids. So when I'm filling it up, it's $170 to fill up that puppy. And I'm not waiting in that Costco line. I'm paying an extra $15. I'm not waiting in that line. You can wait in that line. I'm not waiting in that line. All I have to do is sell one more report for $15 and I'm good. You paid for my not waiting in the line. But you know how much it used to cost to fill up your tank, and now you know what it is today. And because of that difference, you're going, dang it, this inflation is for real. But you guys were already dealing with inflation prior to the Ukraine war, and it was already a problem. The problem was at the grocery store. I went with my wife a couple days ago. We got a few different odds and ends, and of course it's over $100 because that's what it is. Instantly, everybody's looking at their receipt. I didn't look at it because I know what it is. It's called inflation. And that's where it's hitting everybody, that you don't understand it. But once it hits this is where it does its head thing, and then it really affects the economy. It changes some things as far as people are looking, man, well, who uses cash anymore? But this is a good example. I never have money in my wallet any longer. Just kidding, Brendan. I have some money for you. But it's going to affect retail sales. That's really what the bottom line is. Affecting retail sales. And the Fed, let's talk about the Fed. Man, are they behind the 8 ball. I mean, not even, it's like a gigantic ball. It's a boulder. It's huge. They're so far behind, they really blew it. They had all the metrics and everything else. They should have been doing something last summer. They waited until this year, really January, to really announce the rest of what they were going to do because they were already unwinding, but then they really did not begin to win. March, why were they still buying mortgage-backed securities in January when they knew that there was a problem? Well, they thought that Wall Street would freak out. That's why they didn't do it, because you have to unwind it. It's kind of like weaning a baby off of a bottle. I couldn't understand it. It didn't make much sense to me. So now they're really in a pickle. They're doing this hurry-up offense, and they're trying to thread the needle and not cause a recession. And they're like the Cincinnati Bengals. They have like 5 seconds left, and they're behind. It's not looking good for Cincinnati Bengals because all the Rams guys, they're getting the Gatorade thing ready. That's where we're at right now. So Fed rate hike already happened. We've had 2, 0.25%, 0.5%. We're going to get another 0.5% shortly. And then Fed tapering, they tapered down to 0 in March. They don't no longer buying mortgage-backed securities. Yes, they are. They're still buying mortgage-backed securities. They're doing it at the balance sheet. When everybody's paying their mortgages or they pay off, they sell their home and then they get this stuff back, they're actually putting it right back into the system. That's what they had done before when last time that they did this, they drained it down. They brought the Fed, they tapered down to zero in 2014. It took them 3 years to taper. This time, guess when they're tapering? Immediately. They're tapering next month, June. They're starting. They're going to start to taper. They're tapering already, and they want to be at like $30 billion per month starting in September. They're starting slow. They're getting to September because they like to wean us on everything. They just need to go full force and figure this thing out. Be like Paul Volcker, the hero of all Federal Reserve guys, because that's what they kind of need to do. Shock the system. It doesn't matter. We'll get over it. We're all adults in the room. So they're going to do this immediately, but they're doing all this at the same time, and they're like threading the needle because they're trying to not cause a recession. But the odds don't look good for them. And I heard a lot of people say we're in a recession. First quarter was negative. Second quarter might be negative. No, it's not. It would really be shocking if the second quarter was negative, because we're following all the different flags as far as recession's concerned. Do you know what the real problem is? Guess what? Target announced it today, and Walmart, they have way too much inventory. What? What the crap? I thought they said they had an inventory problem. They're saying the reverse now because they ordered all this stuff and they flew it in all different places, and then they were stuck out in boats, and the boats came, and then they got more as they came in. And now, because that was all for the holidays are over, and we thought that this might be a problem, and it is. Target down what, 25% today? Something ridiculous like that. Because they talked about this whole entire issue that they have in inventories and all that stuff, which means everything's going to go on sale. So that's in retail land. That's what happened the first quarter. They didn't let us know until when? Yesterday. Today. That was a long day today. That was today. I started at 5. That seems like yesterday. So yellow flags, recessionary flags. I follow a whole bunch. Fed raises the short-term rate. Flag number 1 is up. Unemployment rate drops below 4%. It's 3.6%. It's getting too hot in employment land. That's my second flag. That's up. It's too hot. Inverted yield curve already happened, 2s and 10s. I won't explain why. I'm just going to tell you these are things I follow. That's up. Housing starts fall 2 quarters straight. 2 months straight. That's all it's done. It's not enough. It's got to do for 2 quarters straight for it to be a real recessionary, and it's not. It's going like this. So that hasn't happened yet. So I only have those 3 flags. I do have another one. Leading economic indicators fall for 6 months straight. It's still awesome right now. Leading economic indicators. Economy still really going. Everybody's thinking about Wall Street and all that stuff, but the leading economic indicators, which is a basket of all kinds of things, is positive right now. Actually, it's negative. Leading economic indicators, I won't even explain it. It's just really good. Retail sales dropping and supply spikes due to weaker demand. So this is what we're seeing. This is retail sales, they've been beats, but now if you take into consideration inflation, it's negative. This is actually a flag that I had to raise because it's actually real dollars out of people's. You're not getting as much goods as you used to with the retail sales that that you are contributing to my statistics. So that's actually negative. So I have 4 flags. I still have 2 to go. It's going to be harder to see those. It means that we're probably not going to see a recession this year. We might see one next year. I don't know. We'll have to see how my flags do. I don't have all 6 flags up that I've been following for every recession. And understand this, in this room, did you guys know that only 2 out of the last 6 recessions affected housing? It is the savings and loan scandal. Read about it. We did dumb things in the 80s and 90s, and then they had to take over savings and loans and things like that, banks. Read about it, because it was a mini version of what was to come with the Great Recession, where we did everything exponentially wrong. Everything, and brought down the whole entire world in the process. So those are the 2 where we did bad things, and what did it do? It affected real estate. The other 4, the real estate kept chugging along. As a matter of fact, in the 80s, real estate went positive. Now, real values, as far as how much it went up and then how much inflation was, well, yes, it was at like 16%. It was negative for a while, but that's taken into consideration, adjusted for inflation. But as far as the values were going up during 1980s. So 4 out of the last 6 recessions, the housing market continued to go up. So know that that's probably what's going to happen. Job market, man, jobs is insane right now. There's like 0.6 persons, I don't know what you call 0.6 person, half a person, available for every job opening right now. That's a problem. They're hoping and they're throwing everything they can at it to see that that number shrinks. That's what the Fed's trying to do, and they're trying to cool down the housing market that's out of control. They're now paying attention. They ran this thing about bubbles. You guys read that from the Dallas Fed about bubbles, where they said it's a big bubble. If you read the fine print, it said the Dallas Fed. This is not the Dallas Fed. It's the opinions of people that work for the Dallas Fed. Did that make it in any of the headlines? No. They just said the Dallas Fed and everything that you listen to, and they said that it's a bubble. And the only thing they were talking about is exuberance. That we were being too exuberant. That's all those $300,000 above the last comp. That's a little bit of what I call, it's a little bit of fluff in the market. It's froth, but it does not mean that we're going to have a downturn. Interest rates. I've had to constantly adjust this based upon Fed speak, and right now it's going to be bouncing between 4.5% and 6%. And know that the lower the number, the more of a seller's market it is. But at 6%, we're going to make our way to a balanced market. It doesn't mean it's a buyer's market. Right. It means it's a balanced market. Everybody forgets this. It doesn't have to be one or the other. It could be in between, where everybody kumbaya. Buyers and sellers have to figure it out and come together. That's what a balanced market is. And I'll show you exactly what that is later. But if you want to know where interest rates are going to go, I don't know, have a couple more glasses of wine, and then we'll throw it at a dartboard, because that is, I'm telling you, I got this wrong. Every economist got it wrong. We had no idea what the Fed, and that they were going to constantly launch every other week. As soon as the market started to do a little bit better, they would say something else that would disrupt the market, and all of a sudden 10-year treasuries would go up and interest rates would go up higher. They kept on jacking with our rates. They kept on messing with it as much as they possibly could, because they really want to slow down the market. And they're doing it because they have to. This is what they have to do. So they are actually trying it with that bubble thing that I talked to you about. That was on purpose. That was intentional. That was to throw something at the housing market to continue to make it slow down. And the housing market, speaking of that, yes, absolutely insane, right? Insanity. That's what you guys have been dealing with, and it's been like this for quite some time. And it's a supply and demand issue where, we've had this shrinking supply that we've been dealing with for quite some time, right? And I called it a supply crisis. Then I changed it and called it a supply catastrophe, because that's what really we're dealing with, supply catastrophe. But it's changing. It is changing. This is Altos Research. This is single-family residence homes in all of United States of America, and this comes out every single Monday. And the latest is at 318,208. It actually surpassed last year at this time, which was 313. It's the first time that we have year-over-year gain, or that this year is larger than last year since 2019. So that is a good sign, and it is here to stay for a long time. We're always going to talk about there's more homes on the market than last year, and I will continue to let you know what that is. We bottomed out this year at a lower rate than level than last year. We were at 307 was a low of all time. Then this year we reached 241,000 March 7th, but it's going up, and it's going up faster than it's gone up in a long time. And there's a seasonality of the market: spring, summer, autumn, holidays, and winter. Holidays is the slowest time of the year. You might close a lot in December, but I'm telling you, you're not opening a lot of escrows in December. This is when you plan vacations. This is the December and January is when you should plan your vacations. I'm here to tell you right now, this is when you book it for this year, for sure. The last couple years, definitely into 2020, definitely at the end of 2021, it was busy during the holidays. This year, you get to enjoy your holidays. I give you permission. And the market is going to behave that way for you guys. And we're in the spring. This is when inventory climbs and typically demand climbs, but something happened. And this is for all of Southern California. I actually had to update this for this report. And this is all of SoCal. You see this? March to August is when the most number of homes come on the market. Number one month for homes coming on the market is the month of May, and we're in the number one month. Number two is April. Number 4 is March, number 3 is June, and then July, then August. So pretty much from March to August, you can see not a big difference. There's a lot of homes that come on the market. I don't understand August. I can tell you one of the markets, San Diego, they have a lot of homes come on the market in the month of August. We don't do that in Orange County. But I hope that after enough people subscribe to my report in San Diego that they can convince their sellers to place their homes on the market in July, not August. August does not make sense because the kids go back to school. And this is why people want to transact and place their home on the market in May, because that's when the kids you place into escrow. That's what I'm talking about. You place in escrow in May. You're going to close after the kids are out of school. Kid out of school right now. This is a good time. I've got the rest of the kids in the next couple of weeks. They're all going to be coming and staying with us in my house on a daily basis while I'm doing presentations. And I have kids running in, screaming at the top of their lungs. Yeah, that happens. Not Brennan. Brennan's going to try to help me control it. But that's when everybody wants to close. But they place their homes on the market during the spring. And in summer, you need to place your home on the market by July, because if you don't, kids are going back to school in August. When are you going back to school, Brennan? August. Everybody, August. That's when you're going back to school, is August. So you're done. You can't place your home on the market because homeowners, they want to move around when the kids are out of school, not when they're in school. It's very disruptive. So and people will do it at all times of the year, but I'm telling you, this is when it happens. Happens across the country this way. So there are cracks in the market, but I'm here to tell you, what's happening here is my speedometer, you see, it's kind of broken. It's like fast. That's where we went from, and where we're shifting to is there. We're going forward, period. It's still a seller's market. This is all a seller's market if you going forward. And I'm here to tell you right now, it's not a bubble. It's not a bubble. I really don't care what anybody says. They could call it a bubble all day long. I'm sitting there saying, okay, how is this market going to go down 30%? Explain to me. Explain it to me, because I really don't understand it. Because there's a missing ingredient to that happening. Do you know what that missing ingredient is? It's supply. We need supply. A lot of it. And I'll show you later how much supply we need. We need a lot. So we're tapping on the brakes a little bit because interest rates have gone up. That's it. As interest rates rise with duration, that means that they have to stay above 4.5% with duration. And this is the report that I kept on talking about over and over again. I couldn't wait for it to happen because I can't stand an insane market. Anybody really enjoy the insane market of a market time of immediately instantaneous success? Sounds like a lot of fun, but we can't do it forever. It just doesn't make sense. So eventually they were going to have to cool it off, and interest rates did something ridiculous this year. That's the dotted yellow line. We've been here before. That was 2013. We had interest rates go up, and that was the taper tantrum. Nothing compared to what we had this year. As a matter of fact, we also did this in 2018. Both of those led to a really slow end of the year for 2013 and an end of the year for 2018, setting up a nice 2014 and a nice 2018. That's why I was hoping for it, but we got it really fast. And with what happens is you have interest rates rise, demand starts to peel back. When demand peels back, it allows the inventory to rise, and then market times rise. And how are we going to build this inventory? Dogs. You guys know what I'm talking about. The property that looks like a dog, smells like a dog, looks like a dog, that thing better be priced like a dog. Please don't price it according to the last comp. That's not going to work, period. Dogs are going to sit on the market and accumulate, as well as properties in inferior locations. If you have two properties, one has a jet plane flying right overhead and a second one, same exact one, that doesn't, which one are you going to buy? The one without a jet plane. During the market where it's going insane, people are going, I'll buy that. Whatever, I'll buy that one, because there's nothing available. But now there's more. These ones will sit and accumulate. And then there's this bad boy. Overpriced listings. But anyways, overpriced properties are going to accumulate and sit. I really don't care. I've seen what people have done. I've already heard some of the ridiculous stories from agents that have been doing this for a long time that have to deal with these ridiculous sellers that go, yeah, I know that one's bigger and has a view and has a pool and is updated, but mine's pretty good.
I have a new toilet.
Yeah. I redid the kitchen. Smaller, backs up to a slope, $100,000 above that one that's up there. That makes no sense to me, and this is the kind of logic that you're dealing with. So overpriced, this is what we're going to be dealing with. So we're going to accumulate a whole bunch of homes on the market off of those. However, there is a problem. It's this. There's not enough homes on the market. And for all of Southern California, in 2020, we were missing 24,000 homes. That was down 9% compared to 2017, 18, and 19 when things were normal. So we were missing 24,000 homes. That's COVID, right? You understand that. And then in 2021, it was down another 7%, missing 20,000 homes. And then January to April of this year, we're missing 15,000 homes so far, down 16%. What's going on? Yeah, refis are done. That's not really what it's. So January to April 2022, it's down 16%. These are number of new homes coming on the market. And yes, you're right with the refis. And we're going to get to that, mister. You're totally stealing my thunder. Southern California new listings monthly. This is it. The orange lines are this year. This was COVID. You could see COVID for the months of April and May didn't look so very hot, right? Well, of course, that was when we were all locked down and couldn't move. And we didn't know if we could sell any more real estate. But there's a new trend that has evolved, and this is the old trend. Where will I go? Where am I going to go? Well, there's plenty now, and there's more to purchase. There's some stuff that's been sitting on the market for like a long time. They had to reduce their price. So why aren't you selling? I'm pretty happy. I have rising home prices. Mortgage rates are rising, and I love my fixed low rate. I'm a prisoner in my home, though. I can't move. Those are wooden bars, by the way. She could break right through them if she needed to. She is in love with not her home, but her loan. She loves her loan. She ain't moving because she's refinanced. She's pretty happy with her 2.8% mortgage versus a 5.5% mortgage today. So I did the math for you. This is what I look like with a beard, no hair. If you want to move up, purchase in 2015, this is a real live example in my backyard. $665,000 purchased in 2015, that's 7 years ago, right? Payment was 3% because they refinanced, 90% LTV, $2,523 per month. Property taxes of $610 per month. What a deal. Total monthly, $3,133 per month. They sold mid-March for $1 million. Net proceeds of $380,000. By the way, the average net proceeds for Southern California, $310,000. Wow. That's average. Yeah, wow. We're just taking our money and we're going anywhere in the United States that we want. It's like this big menu. I'm going to go wherever I want. I'm loaded. So yeah, say hello to the bugs and the fireflies. New purchase of $1.2 million. They're thinking about doing this, selling their house. 3% loan, $380,000 down, $3,457 per month. Property taxes of $1,100, it's a little bit higher than what they were at before. Total monthly is $4,557. They're okay with that because the monthly increase is only $1,424 per month. Annual increase is $17,000. Wait a minute, but she put 3% in there. Silly. Then she met with their favorite lender and 5.45% loan. That was as of this morning. $380,000 down. This is average across the United States, by the way, with the 10% down. That's what I like to compare to. You might have 20% down people or people putting more money. But $380,000, $4,630 per month, $1,100 per month. Now it's $5,730. And rather than, it's $2,597 per month more. And rather than $17,000, it's $31,164 more per year. Now they're saying, nope, not doing it. Some people are. Some people are going, no big deal. I mean, I got a raise, you got a raise. We were a dual income family. We're doing it. And it's happening. I can show you it's happening because and a lot of millennials are going, I really don't care. They're getting brand new and they're meeting with you. They're figuring it out and they're happy. They're going, I'm going to go buy something. And everyone else is all miserable because they've been in the market for a long time. And they're going to go purchase something. The new buyers are the ones to work with. They're like awesome. And they're so excited once they get into escrow, they're closing. But there is a red flag. It's affordability. Not everyone can afford these higher prices and the higher rates as well. I've done the math. I take the average, the rate, and I take the income and all that stuff, and where prices are at. And it's a little bit of a red flag. It's very reminiscent of where we were prior to the Great Recession. But this time, everybody's just backing off, and we're seeing it do what it's supposed to do. We're not doing teaser rates and everything else. So they're happy drinking their cup of coffee, sitting there. Look how much equity we have, checking Zillow, all that stuff. And don't feel sorry for Mr. and Mrs. Homeowner. I don't feel sorry for them. Do you feel sorry for them? Nope, I don't feel sorry for them. They have a really good credit scores. Even recently, you could see there's fewer purchasers. That's what that is, the beginning of the first quarter of this year. But blue is 760 plus credit scores. They're solid. Over here on the left, not solid. This was prior to the Great Recession. This is the dogs and the dead people and this teaser rate loans and all that stuff, lots of mixed bag of credit. Ridiculous, right? That they shouldn't have been purchasing, and yet they did, and then they couldn't afford their home when the thing reset. So, and they have mounds of equity. That equity in the middle, that's like artificial equity, once again with dogs and dead people. But on the right-hand side, this is real equity, and it's not going to evaporate at all. Maybe a tiny bit in some markets, but who cares? They're sitting with so much equity, it's absolutely fantastic. So there's going to be no panic selling. Who in this room is going to panic sell? Because all of a sudden the market really cools. Anybody you know that you sold houses to are going to go, yeah, I can't wait to sell my house and then go rent. How's that working out for them? How's the rental market in Orange County? Orange County has the lowest vacancy rate in the country. Orange County. Congratulations. Really hard to find a lease and hard to find a house. Getting easier to find a house though. So there you go. No panic selling. I've heard all kinds of people say there's going to be panic selling from investors. I do know some investors that bought a whole bunch of things with hard money. Those are the investors that are in trouble. Yeah. If they did that, then they're in trouble. Is that everybody out there? No. Somebody's trying to make it out that all of them did it. I talked to one agent that has a hard money investor that's now kind of caught and has a whole bunch of properties. Well, they need to unload now, is what I said. Immediately. I'd unload if they have hard money loans on that stuff. So that's what I would do if I was an investor. But a lot of investors that are waiting for the market to change a little bit, they're going to have a lot of fixer-upper properties that are overpriced. They're going to be easy to hit later on this year, probably like at the end of summer. So this is the active listing inventory. This is where we are right now. See that spike? That is all of Southern California. I go backwards. We're up, but it's a crack. The crack is this. The crack is the change. The change of what we haven't seen. That crack is we're seeing the listing inventory go up at a pretty fast clip, at a really fast pace. May 12th, that was last Thursday, just under 19,000 homes. It was up 30% or 4,389 homes in 4 weeks. That's a pretty big jump. As a matter of fact, it was the largest 4-week rise since tracking began a decade ago of all of SoCal. I go back to Orange County. It was the largest since like 2010 or something like that. So it was a big giant jump. Last year we were at 16,556. That's down 13% or 2,420 less than where we are today. It just crossed over in Orange County and just crossed over in San Diego County and already was in Riverside and San Bernardino. LA is last. They have not crossed over. They're going to cross over either this week or next week, where there will be more homes on the market than the prior year for the first time since 2019. So we're doing it just like the rest of the country is doing it. Same thing's happening in Arizona. Same thing is happening in Clark County. Bay Area is a little bit slower, but they'll get there too. The 3-year average prior to COVID was 38,466. That's where we should be when things were normal. That's 103% more than where we are today. That is double where we are right now. So that's just where we get to normal, where we had 5% appreciation. So it's going to take us a long time just to get to normal. It could be the better part of this year, and we might not even get there. So what's it going to do from here? Well, it's going to continue to go up until it typically peaks during the summer, but not this year. Not this year, because you guys are going to place homes on the market in July and August. They're going to be overpriced with those signs, and they're going to sit and linger and accumulate. And they would have been successful last year and the year before because the market will go ahead and absorb them. The market will not absorb overpriced properties. They will sit. And instead, it's going to continue to go up, and it will peak between October and Thanksgiving. We're going to continue to have more and more homes. It's going to get slower and slower as the year progresses. Yeah. I've seen this book. I've read it before, like many times. So this is going to happen as long as we have rates remain higher with duration. And this is also from Altos Research. This is the number of price reductions, by the way. You guys are the first people. More than one people, persons. Okay. Yes, you can see this, Altus Research, it's going up. Price reductions rising rapidly. 20.9% of all properties in the United States have reduced their price. And it's going up fast. It was like last year where this was ridiculous. It's not where it was normally, but it's definitely going up really fast. So know that. Los Angeles, 19% have reduce their price of the entire inventory. Orange County is at 19%, Riverside's at 23%, San Bernardino is at 25%, and San Diego County is at 19%. So Southern California demand, this is the last 30 days worth of escrow activity. Yeah, this is what it was. You overprice this puppy and bam, that thing's gone. I have to change this just to say demand. Don't want to put that in there. But it's like, please take a number. If you price your home according to the last comp and it's in good condition, not a dog, it will fly. It should fly in this market still today because there's plenty of buyers out there. The problem is that's not what the sellers are doing. They're not taking advantage of the marketplace. It was rates that was fueling demand. That's definitely, well, rates is slowing demand at this point. What was fueling demand is scarcity. I've talked about before. It's like the TP. But there's a scarcity of cars, and there's a market adjustment fee, and that market adjustment fee, people are willing to pay. Yep. Just like they're willing to pay for housing, they're still paying it if you price it right. Because there's still not enough houses out there. Things are selling for over asking like an auction, but it's frothy out there. Please do not partake in the froth. Please. It's not a smart bet right now because I can already tell you where the market's going. Participate in it now. Down the road, your buyer's going to look at all the comps. And they're going to see that one that went $200,000 above the last comp. They're going, I'm not paying that, right? Your buyer's going to say, I'm not paying that. And they're going to look at all the other stuff, or they're going to go someplace else that's going to be similar, and somebody else paid the $200,000 more. So froth is for real. Darn it, I forgot to make this so that it'll show up. So pretend that I showed you this in a minute, but it doesn't even help. 72.8% in the month of April closed above their asking price. It was the highest ever. It beat July of last year. The number of homes in all of California that sold in the month of April, 72.8% sold above their asking price. Highest ever. It beat July, which was at 71%. 72.8% is huge. We were already way up there the prior month in the month of March. Now we're there at April. This was just released yesterday. This is, by the way, this is California Association of Realtors. This is every single month. You can find it yourself on car.org. And I just pull off all this stuff and add this stuff and snip it out, and then I forgot to make it so that it's actioned like. 8 days is the median time on market, and sales to list price ratio, 104.2%. 4.2% above the asking price on average in all of California. And why? Because this is still left over from when there wasn't enough homes on the market that closed escrow in April. This is changing, and it's evolving fast. Crack, demand. This is the last 30 days worth of escrow activity. You can see kind of what it did. See, we topped out up here, and it's gone down. May 12th, we were at 15,188 for all of Southern California. That's 0% or down 38 pending sales. So in a 2-week period of time, it only went down 38 pending sales in all of SoCal. What that means is that we hit a peak here on March 31st, and it came down, and now we've absorbed the 5%. We were supposed to continue to rise and get up here, but because rates were going up so fast, it was eating into our demand, so we had fewer escrows, and they started to diminish. That's what's going on here. But now we've absorbed it, and it's kind of leveled off. So last year at this time, we were at 19,755 for all of SoCal. That's 30% more, or 4,567 more escrows. And March 17th to May 12th, we actually dropped 7%, or 1,123 escrows. So it actually went down, and this is the time period where we continue to go up until we peak at the end of April to the end of May. And 3-year average is 17,929, which is 18% higher than where we are today, or 2,741. So we're less than the average prior to COVID. So it's really eating into demand right now. And nowhere is it doing it more than in Orange County. And Southern California demand, this is where it typically peaks. Like I said, we had an early peak. It will continue to drive down slowly but surely, just a little bit at a time. So I'll continue to watch. It follows this normal thing. That green line was COVID year. It was just a belated spring market. So you can't even compare it to the green line. And how fast is this market going? This is another crack. On March 17th, we were at 24 days for all of Southern California. And on May 12th, last week, it's now at 37 days. So it's a 2-week period of time, more almost, and since March 17th to May 12th. And then last year, we were at 25 days at this time period, and a 3-year average is 65 days. So we're trying to make our way back towards average, which is what this wants to do. And we're making our way. We went from 24 to 37. It will eventually get there. Understand this. We're down here at this orange right here, right? That's 2022. This yellow line right here, anything below that is a seller's market. All of it below that is a seller's market. Anything below 90 days. Anything below 60 is hot. That means we're having appreciation. It's really fast. We usually get it in the spring. And then this between 90 and 120, this is that balance I talked to you about. It's kumbaya. This is between buyers and sellers. Doesn't favor one or the other. This is where it's like no man's land, but we get there and we stay there for a while. We've actually been here before. We were there at the end of 2018 when we had 5% interest rates for a minute. Above that is a slight buyer's market. And then above this big red line, that is where we have a deep buyer's market where you get values that are falling. We are nowhere close to that. We're way down here. So understand that. I'm watching it, and it's really slow to move. It's like watching grass grow. I like this, though. This is really fun for me to do on an every other week basis. This is what I enjoy. And then bringing it to you. And then anything below 40 is insane. We are about to cross over insane. And it will be less insane. It's going to be like a hot seller's market, not an insane market. We're not supposed to behave under 40 days. I didn't even know that really existed. 2013, we did it for a moment, and we've been doing it since 2020. It's been constant. It's been a ridiculous market, and it's about to end. And it can't end soon enough, as far as I'm concerned. I could not tolerate how quick values were going up. It did not make sense to me. And it had a lot to do with the Fed. And where's this going to go? I drew a nice big blue line. It's going to go all the way up to where it still will be a seller's market at the end of the year, probably. It could go towards balanced. We'll just have to see how everything evolves from here. And home values, I can still tell you they're still rising at a ridiculous clip. But it's slowing. But there's just not enough product for it to slow fast enough. So as far as an end to this is concerned, I cannot say that we're at a top of the market, an inflection point where it's going down. The inflection point is it's slowing. That's it. It's not turning into a buyer's market because we're missing something, right? Inventory still, and I'll show you in a second. But there are headwinds, these higher rates, a lot of geopolitical things going on. There's a problem now with Finland, and I guess in Sweden. They want to become part of the NATO, and then I guess, Turkey doesn't want them to be a part of it. So there's all this geopolitical stuff that's going on. So just know that happens. And when rates go up, it is a total motivator. Everybody says, yeah, it motivates people to go ahead and purchase. But when they go up too high, it becomes a deterrent. And that's where we're at right now. It's kind of deterring some buyers from purchasing. And you could see it in the impact on affordability. 3% is where we were like at the start of the year. If you wanted a $4,000 per month desired mortgage payment with 10% down, you're looking at $1,054,000 house. Well, today you're looking at a $782,000 house. That's a haircut since the beginning of this year. That's real, right?
That's a buzz cut.
Yeah. Well, that's what I do, Brandon, when people take pictures. So, the rising rates impact on affordability. You can see this is also, if you wanted $1 million home with 10% down, you were looking at a $3,794 payment, and now you're looking at $5,110. This is just principal and interest. This is just math. You know math? That. I just did the math for you. So it's a little bit more expensive, right? And so as housing slows, when will home prices have begun falling. Here are the cities where they're down the most. I couldn't believe that. This was actually picked up by some YouTube bloggers and bloggers that I actually enjoy listening to, and it went crazy when they quoted this article, because this is ridiculous. They told me that the city of Los Angeles actually went down at the beginning of this year. That didn't happen. So we're in a historically overvalued housing market, and these cities could see house prices drop 10%, Moody's say. And then another housing bubble we're skating close to one, says Realtor.com economist. So there's all this noise. It really gets me mad. I already told you that. We're going to go from 230 miles per hour, and we're going to shift, like I said, maybe 70, maybe 40, right? Values are going to go from 20 to 5%. 20% plus to 5%. This is going to tick off a lot of people because they're used to it selling instantaneously for $150,000 above the last comp. That's not going to happen anymore. It's going to slow down, and we're not going in reverse. That's a buyer's market. We're going forward. Until I see more, I'll call it when I see it. I just don't see it. I because there's a missing ingredient. I told you. Man, that's a supply. This is Southern California. We talked about this. This is about that we're topped out at 50,000 homes. That's the top that it even got for all of Southern California since 2012. Only in Orange County did I go backwards, but I built one for Southern California. See, and this is where we are on the right-hand side. See that little thing way over there? So I built this one. This is for the prior to the Great Recession and during the Great Recession. So I put it right here, stacked it up. This, as you can see, it continues right there. This was where we were prior, during the Great 2007, 120,000 homes in all of Southern California on the market. 120,000. I told you about 50,000 was the height. Actually, 43,000 was the average top. And 18,976 is where we are today. We have a long way to go for there to be the kind of market that people are talking about 30 to 40% off. And where in the world are we going to go from 19,000 to 120,000 homes on the market? Where?
I'm working on it.
Yeah. Yeah, where are these? Seriously, I want to know where they're at. I can't wait for people to tell me where it's all going to come from. I have no idea. So my market overview looks like this. Okay, forbearance. I have to tell you really quick. All these people that think that things are going to go foreclosure wave and stuff like that, I have to answer the bell on this. Forbearance continues to drop on a monthly basis. Black Knight comes out with this thing every month. We're down to 688,000 people in forbearance across the United States. 93% have 10% plus equity. 4.3 million in June of 2020. That was the height of the number of people in it all at once, but 8.1 million people took advantage of forbearance. And these are the people that exited forbearance. 4.3 million, 58% are performing. And another 32%, 2.4 million, paid it off, which means they probably sold their house, which is 90%, right? I did my math, 90%. Removed, delinquent, working with the workout unit because they recently came out of forbearance. This number's actually gone down because it was really high towards the end of last year. It's at 368,000, 5%. Are working with the workout unit, trying to figure out if they go here or if they sell. Now, the people that are no longer working with the workout unit and are now totally delinquent in trouble, 279,000 across the United States. The number that are in foreclosure, 78,000. It went from 72 to 78,000 from month to month. There's your wave, folks, 78,000. We had thousands upon thousands across the United States during the Great Recession. We're not having this. It's not even coming. And the national delinquency rate is at an all-time low. 2.84%. All-time low. That's including everything in forbearance. So no foreclosure wave. And prices continue to go up. It's at 19.8%. I can't wait to see the next one that comes out like next week. And I think it's going to be plus 20%. It's going to be the highest ever. I think that's coming because they're a couple months behind. And we know that values are really going up high. This is where values are right now. This is the Case-Shiller nominal. So this is how high that they've gone. And you can see where it's really high. It's way higher than over here. People are making more than they did prior to the Great Recession. A lot more. On average, 30% more than what they were prior to the Great Recession. So understand that. You can't even compare the two. Normally, it goes up over time. It's just gone up quite a bit right now. And this is Southern California closed sales year over year. Year over year, January to April is down 11% compared to last year. But compared to 2019, it's up 18%. And compared to 2018, it's very similar to 2018. In Los Angeles, it's down 15% year over year, January to April. In Orange County, it's down 21%. So you in this room probably feel a lot more because we had a really good year last year. Best year since 2005 in terms of volume. Not volume, in terms of units. In terms of volume, it was the biggest bonanza year of all time, period. And Riverside down 4%, San Bernardino down 4%, San Diego down 13%. So it's LA and Orange County are hitting it hard. And luxury is surging. That's on the right-hand side. Luxury, by the way, for Orange County is now $2 million plus, top 10%. Last year was $1.5 million at the beginning of January 2021. People got mad at me halfway through the year. I told them I'd adjust it once at the end of the year. I did. It's now 2 million plus. It's also 2 million plus in LA. In San Diego, it's 1.5 million plus. And in San Bernardino Riverside, it's both 800,000 plus. And we're doing the most ever transactions above that, all of our luxury thresholds when I add them all up. And there they are in orange. And a matter of fact, it's up 29% over last year, which is a total record year. Last year, it's just absolutely ridiculous. This is really strong, except it's starting to unwind. Demand is falling year over year for luxury. Luxury caught a cold. We just don't know it yet. I can see it in the demand numbers. So it's coming. And it's because why? It's very, very volatile on Wall Street. How did Wall Street do today? Yeah, I heard somebody. I wasn't paying attention. Somebody tell me what it did. What was it?
1160.
1160. Yikes. Wow, that was lower than when I saw it earlier. Okay, I need a drink. Anyway, 2022 up 29%. So that's 29% over last year. That's huge. And this is, that was Orange County demand. I show you. See, it's less than last year. See? This shows you we're $2 million. And it's actually gone down more than that. I didn't update this one. And how will 2022 play out? Here you are. Frustrated buyers not as willing to stretch as year progresses. Well, we already know that, right? But I was talking about this before when I was forecasting this year. As rates rise, sellers will not get away with overpricing, especially second half of the year. Second half is going to be a real hard time with sellers. You're going to have your work cut out for you. You're going to be earning every dime of it. Rates between 4.5% to 6%. Available homes ultra low until the second half of the year. Demand down year over year. Total sales down 10 to 15% compared to 2021. That's for all of SoCal. And values to rise between 10 to 12%. And distress rises slightly, but no wave. And luxury continues to soar first half of the year, but decelerates as year progresses. So that's kind of what has been going on. Normal housing cycle. So spring is the best and all that good stuff. So now I do have a housing debrief. I do it, I guess, tomorrow. I have to come up with a topic after this. I was too busy preparing. Every Thursday at 3 p.m. Reports on Housing, both on YouTube and Facebook. That's my handle, Reports on Housing. So thank you so much.